What's going on, everybody? It's Fisher Trader here. Welcome to another segment of debit spreads on my big whiteboard. So what is a debit spread? A debit spread is where on either side, a call or a put. On the call side, you would buy the call, all right, closer to the money, say the price is at 10 bucks. We would buy an $11 call, okay, and then we would sell at the same time another call for, say, we'll keep it simple, so 12 bucks, all right? So we're going to sell the 12, we're gonna buy the 11. The difference between these strikes is your max profit, all right? And I'll explain that in a second. So the max profit is basically between 12 and 11, so just subtract, so it's $1. $1 in option world is 100 bucks, all right? So say we pay, we'll say $50, right? We pay $50 for this debit spread. So your max profit is $100 minus your $50 that you paid, which gives you a max actual realized profit of 50 bucks, right? So $100 cost, $50, I'm sorry. $50 cost, $100 max profit. So your actual max profit is only going to be $50. And whatever the difference in whatever debit spread, that's how that works. The object is to get the max profit as high as possible versus the other, the cost being as low as possible. So same situation. So say like what I did with Tesla, right? And I should have held it till Monday like I originally planned, but I went ahead and just closed it and took profit. So I bought a 767.50, all right, and a 770, all right. So that's sold this call, bought this call, all right. So my cost on this was 30 bucks, all right, so cost. So the difference in strikes here is 250, okay? $2.50 times 100 in options world is $250. So you got that here, right? So I sold it at 80 bucks today because Tesla was sitting up. Wasn't sure what the market was gonna do on Friday. But as you all can see right now, if you're looking at futures or anything like that, the entire market is just elevating rapidly. So the recovery is very interesting at this point because we know that the Fed is just pumping money into the market left and right. Billions and billions and billions of dollars at a time. They initially had $500 billion waves that they were going to put in. So I closed this, so I took a $50 profit on the trade. Excellent. Now here's what happened. So my cost was still, 30 bucks. I sold it. I have my other positions are chilling right now, so I'm not concerned with like looking at it all the time or whatever. So I look back at what Tesla's doing now. Tesla's at like 775 or 780. So this entire position would be in the money tomorrow. Expirations next Friday, right? So to realize the max profit, it would have to close next week with both of these being in the money, all right? Now, do you really want to wait until you're all the way in the money, and up to expiration? Because if you follow me at all and you understand my rules, one of the rules is to never let an option expire if you can help it. And with this position expiring April 24, all right, I have all next week. I should have took my initial plan, but we don't know what's going to happen over the weekend. Tomorrow could be excellent, but here's what happened. Tesla flew up after hours, but before it closed around 7:44. This position was actually now worth $200. So a $170 profit on a $30 trade for the close. And this will be actually much more tomorrow. It'll probably be like 220, 225. And it could possibly max out almost, within like 10 or 15 bucks if Tesla continues to rise. So if you looked at my charts on Instagram and my Facebook page, The Real Fisher Trader, you would have seen my charts posted up for the Bollinger Band showing where I expected Tesla to go. If for some reason the lawsuit, I'm taking the company public issue caused any more problems or anything like that actually happened, we could have seen it go down to maybe 650, 600. But what happened was it went the opposite direction and it actually went closer to what I said. On the other side was $800 and it's at 760, 770 right now. So chances are tomorrow it could easily soar another 50, 100 bucks. And you can't trade same-day expirations on Robinhood. I don't even think Webull you can do that. But with debit spreads, you can't trade on a cash account with debit spreads. It has to be a standard trading account or margin, you know. And so what's happening here is I'm receiving the credit for the sold call, but I paid for the bought call, of course. But that credit set this off. These positions are thousands of dollars, like $2,000 or $3,000 each. And then you subtract the difference of what those costs are, and you get what I'm actually paying was $30. So yes, my top side limit was $250, but if you look at the ratio, 250 max profit versus a $30 buy-in, I should have bought 10 of these, you know, but you know, it is what it is. You know, we like to be careful trading. You don't want to throw your whole account and stuff. You know, you got a lot of people that put a lot of money on thinking one way about something. And I believe Umar actually, you know, finally closed his SPY put position just because SPY is at like 289 or 288 or something like that right now, which is ridiculous considering everything that happened. But it's still nowhere near the 339 high that it was back in March. But here's what's happening is the government is pumping the money. The federal government is pumping all this money into the market. So now you have people naturally getting on the wave, riding it back up, right? And what's going to happen is it's either going to continue up, all right, a slow, nice V recovery. It's not going to be a perfect V like we've been seeing. But what we can do is hope and expect, rather, not really hope, but expect the Fed to continue pumping money, people continue to ride the ride. Probably best case back to around 315, but if it passes 315, we're going to touch 339, 340 again. And then at that point, I'm going to buy myself, not trading advice, I'm going to open up puts again, and I'm going to leave them alone this time. I believe that in 2022 to 2024, SPY could easily see a huge build range, pending what happens with the recession or depression or whatever. But we're in this to make money, regardless of whether the market's going up or down. You know, pending you still have a job and you have money, et cetera, et cetera. So what we're looking at here is a safer way, not the safest, there's still risk because this is still a directional trade. It can either go sideways in the range that you chose, it can go up, it can go way up, you know, kind of up, sideways, or all the way up. If it goes kind of down, or all the way down, you're gonna lose money. But it is what it is. You can always close a position, you know, before the expiration. And again, like I said, I preach that. So I practice what I preach. Unlike a lot of people who try to teach you how to do these things, they don't actually even trade themselves. They trade in paper accounts. They trade other people's accounts or they show other people's accounts rather. They show massive Lambo buying properties, profits, and et cetera, to get you to buy their program, their class, their course, whatever the heck they're doing to build that idea in your head, which apparently works because those people are pretty successful. But for the fact of the matter is that if you really want to know how to trade longevity-wise, you need to learn this stuff yourself because nobody's going to be there to hold your hand for 20 years. I'm sorry, it's not going to work that way. These people will eventually have enough money to put that thing on autopilot, hire a couple people they can delegate stuff to. Hey, you go show up at this meeting. Hey, you go do this. Hey, you go do this. Build this class for me. Maybe throw some money in artificial intelligence or, you know, some kind of automated, you know, website system or whatever. And what's going to happen is that they'll just continue revenue, right? Like a Discord chat is basically that. It's a compounding monthly revenue for between $5 and $10, $20, $100, $500, however much these people are charging. And, you know, it is what it is. The chats are great. In most cases, sometimes you got a bunch of young people or a bunch of kids who really don't care about trading. They're just in there throwing around whatever money they have, trust fund money, savings accounts. They don't really know what they're talking about. It's like they're on stock splits or something. And it gets really annoying. Matter of fact, it gets really annoying. But anyway, back to the debit spreads. So, again, you can make money up, sideways, or kind of up. And what's going to happen here is that's for calls, right? Now, puts, if you buy a put debit spread, it's going to be the same thing. You're just going the opposite direction. So, with the put debit spread, we'll use the same example we did. We'll say the price is at $10, all right? And then we're going to buy this call. We're going to buy the one closer to the money, right? So we're going to buy a 10. We'll just say it's at 9 to make this, we'll say it's at 11 to make this a little more progressive here. So buy the $10 put. Buy the $10 put, because the price is at 11, we're going to continue down. And then we're going to sell simultaneously. God, I'm messing up everywhere. We're going to sell this other put for, keep it simple, $9. All right. So now, again, your max profit is $100. Say again, you pay $50 for the position. Your max realized profit is going to be also $50. So it's a very simple equation. The difference between the strikes is max profit for the whole position. All right. What you paid, $50, gets subtracted from this, and that is your max realized profit that you can actually see either A, at expiration if you're completely right on the position and it expires both in the money. All right. Because this sold put or whatever, you want it to be like tip-top touching there, because if you buy this position and it stays, if you buy this position, all right, and it stays right here, it's not going to close at the max profit. We need it to be like right here, like right at the $9 put. We need it to be at like 901 for you to really realize the max profit, and or 850, something like that. That'll realize the max profit as well. So you got to be careful with this, because if you just think you're going to buy a $1 spread and it stays in that range the entire time, but you bought it when, say, the stock price was at $9.50, but you bought, and let's say the price starts going up on you. So say now you have this difference here. So the 50. So you want the $9 to go even further down, right? So you have $11 stock price. Confusing myself here. $11 stock price. All right. You bought at 10, sold 9. If you did this, right? Pretend this wasn't the case. If you did this at $9.50, right? And you bought a 10 put and sold a 9 put, you're in between the spread that you sold. Therefore, you're directly in between the profit that you could maybe realize. Now, here's the issue. If it closes in the same spot, chances are you're not going to realize this profit. But if it closes in the money at, say, we'll just say 901 or 899, you're going to close in the money, right? And what that's going to do is provide you with, at most, the max profit of the position, and or very, very close to it. I tested this out with Ford. I bought it at $9.37, I think it was, per share. I bought the spread. The spread cost me $20. Max profit was $50. I bought it at around $9.37 per. That's what the stock price was at $9.37, and I watched it, and it closed at $9.12. My remaining profit was about $12. So it was funny, because it was actually the difference between where I paid for it and where it closed at. That's actually what I kept. So the position was like $20, 30, I guess 30, whatever I paid for it, whatever the difference is, the 20 to 50. So whatever I paid for it, that's exactly what happened. Now what I did is I developed a strategy that actually makes this more probable in your favor. And as we say, never let anything close on expiration or expire in expiration unless you're selling calls and you're collecting premium for that purpose. What you're going to want to do, what I have actually found that works almost constantly all the time, is a very long expiration. All right, we're talking months here. All right, we're talking like 3 months to maybe even a year. Okay, now the year is going to get a little perplexing, because you got to pay attention to how much you're actually receiving for the debit spread and the max profit. So if you're only getting like $100 off the debit spread, unless you got like 150 of them, you're not really going to realize any real profit potential, and you're just kind of wasting your capital away. So the perfect expiration, in my opinion, for the debit spread, all right, whether it's a put or call debit spread is irrelevant. But remember, a debit spread is still a directional trade. It is not a credit spread. You are not receiving a credit. You are paying for a position, hence debit. Debit card, you're paying your money. Credit card, you're using somebody else's money. Therefore, they're crediting you other money, all right, because of the position. So what you're looking at is the long expiration, 3 months to maybe a year. This is the one that I found that works best. Now, if you are projecting using technical analysis or even fundamentals that the stock is going to go like Tesla did, it was 320, then it came back up, way up to 968, came all the way back down to the high 300s, I believe it was. And what happened is now it's turned around and reversed. So say at $400, you're like, man, I know Tesla's gonna be at $1,000 in December. All right, cool. Well, it's April, so we'll just say you bought a December 18 contract date. All right, that's the debit spread you're wanting, okay? December 18, so you have all kinds of time from now and then. This being April, so you got May all the way to December for what you need to happen. All right, say at that point Tesla's at 400, okay? You're gonna buy a call debit spread in this situation because you're projecting the price will go to 1,000, all right? Let's just do, for that far of expiration, I looked the other day, it was actually gapped up around a little bit. So I think it was 950 to 1,000, and that's your spread difference, okay? We're gonna buy this call. I'm sorry, thinking of puts. We're gonna sell this call, and we're gonna buy this call, all right? And I think the grand total was like, this was back when it was a little lower than what it is now. I think it was like $450, and that was for the entire spread, okay? This is $5,000 here. That's the difference of the spread. 50 times 100, it's $5,000, all right? So you're paying $450 for the opportunity to make $5,000. Now what has to happen? Well, obviously Tesla has to continue way up, all right? If this even gets to 700, this is going to start realizing profit very quickly. So this 450 will probably turn into closer to, at that point, probably 1,200. You know, if it gets up in the 700s when you've already bought this when it was at 4, right? That's a huge gap in difference. Oh, but wait, I can just buy the naked calls. You can, but you're going to get, with that long of expiration, the theta is probably really low, so it's not going to hurt you as bad as buying, like I say, a 3-month or a 2-month. But in this event, you're still capping profit, but your risk is so low. It's only $450 to get this trade, whereas if you buy one of these naked, it'll still be $500-600. But in the event Tesla's like, nah, we're going back down to 350, well, your position that you just paid easily $1,200 for or more, you probably lost easily 25-30% of that. So what debit spreads do, yes, they max your profit, but they actually lower your costs so much that you can literally build this position and mitigate your risk from the get-go, okay? So we're gonna take this off the board, but that is the strategy that I've been using that has been working excessively well on even shorter expirations, which again, I don't recommend. I've been doing this for a while, so I can actually kind of see where my position is going to go if I needed to. And I still cut losses in the event that I feel like the trade is going to just die in the wind. Like I did some spy put. The contracts were like $2 a piece. So I didn't know what was going to happen this week. I know the Fed stopped pumping money on Wednesday. So tomorrow, if the market doesn't fall 30 points on the SPY, then that position is going to expire worthless, but it's only like $16. So it's not a big deal at all. But the actual max profit per part is, I believe it was, I think it was $50. So $50 per contract, but I only paid $5. So $45 max profit per contract, and I had 10 of them. 16 of them, I think, is what I had, and then I sold some. So yeah, so long expiration. But here's, again, this is the trick that I've been using to make this work so well, is I'm buying positions from where I expect the price to be. So we'll use Tesla again. Tesla here, $400, all right? Oh, but man, I can still get a naked call for like $700. Okay, cool. And if you're right, and you buy the $700 cost for a $1,000 call, okay? Say you do this, $700, you're gonna make a lot of money. I'm not gonna lie to you. This is gonna be excellent, exponential profit that you just made. Now, here's the issue. Say Tesla does like this. and it just mowed like 420, 435, 520, and you're all the way, I mean, yeah, that's a lot of money. That's a big gap. But you're all the way in December, okay? But it's slowly creeping. And here's your timeline. Say now, you're in September, and it's only at 520, and you've got a $1,000 call. Data's going to start getting to you a little bit. Now, again, you're still in a good position, and if Tesla just does this and reaches $950,000, you're going to make an exceptional return on this $700 investment or trade, depending on how you look at it. Investing long-term in options to me is sort of investing versus actual trading, where you're day trading or swing trading short positions. But if the same thing occurs, my debit spread that I paid $450 for, and we're going from $950 to $1,000, all right, and I'm capping my profit at $5,000. So yeah, your position, if you got in the money, your position will probably be around $5,000 to $12,000, depending on how quickly it happened. Remember your timeline. So this September, all right, same thing. Say 420, 450, 520, but now you're in September, so now you only got a couple months left. Guess what? Our debit spread is barely losing anything, if it is actually losing anything at all. I've seen some of these trades I've had open for months just sit there on like the same fluctuation. All right, I've got an airline debit spread. I've got like 26 of them, and it just does like this. Literally, it goes way up, way down on the fluctuations of premiums, because nobody really knows where the stock is going to go. But what's going to happen here is I'm capping yes at 5, but it didn't cost me $700 for one. It cost me a little more than half. All right, so $450 is what I paid for this spread, but my max profit is $5,000. Okay, I don't even need to get to $5,000 because I'm in a trade to make money. I'm not in a trade to reach for the stars and try to grab the moon and the stardust and everything else while I'm there. I want this position to make me money. All right, that's all I want. So forget all this. All right. December contract, say the debit spread. Now, am I telling you to only trade debit spreads or credit spreads or anything like that? No, not at all. By any means, if you want to trade long swings like that for something that's pretty high probable for the most part, I would say that Tesla has huge opportunities and swings of prices, whereas just like Amazon today touched 24 and some change, and then it came right back down to 2800. Oh, Jesus Christ, 2380. And, so if you would have bought at that $2,400 top, if you bought calls on that for $2,500 for Friday, you just got reaped. So what's happening here is I'm lowering my costs by easily 50% almost, and sometimes more. I mean, if it's an unprofitable trade to most people and you make it, but something goes right, the news or whatever happens, and it blows the stock up, your debit spread is going to realize a whole lot of profit. Because I watched some the other day, I looked at Tesla. As a matter of fact, the one I opened for 30 was like $11 last week. So it's like, if I bought 100 of them last week for $100 for $1,000, I mean $100, 110 or whatever, 111, then my $50 profit would have been times 100, so it would have been a lot of money, returned to me, versus what I paid. And that's what you want to do. You want to put the odds in your favor, okay? You don't want to just be putting a trade out there, and the next thing you know, say Tesla drops to, 320. Now you have a $700 call, $1,000 call for December, but the stock price just dropped all the way down, to 320 or whatever, and that's going to eat your $700 up, man. Even if it is in December with low theta, that $700 probably just lost easily $150, $200, because the price dramatically went the opposite direction. Therefore, implied volatility changed in the direction, and your price went down. So your cost now for that same trade is probably $500. Okay, for the same position that you paid $7 for. Oh, official trader, or what if I just dollar cost average? Okay, cool. You can average down the position. I did a video on that in one of my Strangles videos. What that means for dollar cost averaging, let me take my time, 24, cool. So what that means is dollar cost averaging is, say you bought the stock for $10, it's going to go up long term, but now it's $8.50. All right, so you bought 100 shares here, okay? You bought 100 shares here, okay? Now it took a dump. Now it's $3. What happens? So yes, your average here was like 9 something, okay? 9 whatever, all right? So now you have a $3 stock price that you paid 10 and $8.50 for, and we can do the math on that, 100 shares times $10, $1,000 bucks, $8.50 is $850, and now you're $300. So your same shares that you paid all this money for are only worth at this point $600 bucks, so you got 200 shares, all right? So the normal cost of this is $3, so I'm going to pay $300 and half this, okay? So now I'm going to bring my total cost, I'm going to add another $300 to it, so now I'm at $900 in, okay? And what's happening here is I took what I paid and brought it way down here. Now it's not going to be $3, it's going to probably be the split difference here. And here's what people don't realize is, okay, should I buy the same 100 shares or should I buy more shares? Well, if you buy the same amount you bought here, your average is still going to be somewhere like the 650 range, right? So what's going to happen necessarily would be to actually buy, and it's not trading advice, this is my opinion on what I would do in this situation. So say I bought these 200 shares, right? But I really know there's some good news coming. I bought shares, so I'm not worried about any expiration times or anything like options. So say we get that same $300 or $3 shares, so $300 bucks per 100. All right, so you know what? I mean, shoot, I spent $1,850 on these. I'll just buy 500. Okay. So now I cap this entire situation. So this 200 shares is only less than half of the initial shares that I'm buying at this point. So $1,500. Okay. So I bought 500 more shares. Now I just paid $1,500 more. So now my whole position is value-wise is these 200, so you're 600. All right. So I totally can't add right now. $2,100. Okay. So $2,100 bucks total cost. Here's what's happening. So now we have 500, 600, 700 shares. All right. So now we got 700 shares. All right. At 2,100. And again, I'm sorry if I lost you, but this is dollar cost averaging. Been doing a lot of days, so my mind's kind of all over the place. So 700 shares, total cost $2,100 now at this point. So what we need to do is, well, our average price at that point is probably going to be like $4. And these are just rough guesstimates. I'm no math genius by any means. If you're exceptional at good at math, trading is probably great for you. Anyway, so 700 shares. So we're gonna leave it alone. Okay, we paid $4. Total average at this point. The price is still at $3. All right, say this is a biotech company. Okay, extremely risky anyway for trading biotechs. Now say all of a sudden she shoots back up to $10. Okay, well now your 700 shares are worth $10 that you lower the cost on. So you're taking that $6 profit per share and adding the 700 to it. So now 700 times 10, you're looking at $7,000. Okay. So what you just did was you paid $2,100 at this point because you averaged down so far because you got the cost average way down from what it was. So you bought all these extra shares and you compounded the low cost against the high cost shares, which dragged your price average down to probably between $4 or $5. But now you have $10 a share. You're done. You're out. $7,000. You made a $4,900 profit on that. Good job. So now, back to options. Dollar cost averaging. Now you understand, hopefully. And I'll do a lot more videos once I get back into the flow of this. So, your option, remember you paid $450 for my debit spread. All right. You paid $700 for your $1,000 call. All right. Man, I know this thing ain't drying out yet. All right. So $1,000 call. My debit spread